Well, hi everyone, welcome to the Buffett and Beyond Stock of the Week, and today we're going over Apple Computer, and it's been doubling the S&P in 5 years. The question is, can this big dog keep up the big dog race? And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's get right into Apple. And we all know what it does. Established in 1977, one of the world's largest makers of PCs and peripheral and consumer products such as the iPhone smartphone, Apple Watch, the iPad tablets, and its Mac line of personal computers. And it also sells operating system services like iCloud storage, which is the big thing now, and Apple Pay, which is nice and easy, and a host of digital content from the popular iTunes Store and other portals. It has approximately 164,000 employees, so it's doing pretty well, folks. Nice company. And let's look at a brief look comparing it to the average stock. The blue stocks in blue are the average stocks out there. First thing we're looking at, the clean surplus return on equity, and yes, the green is April. So we're looking at the clean surplus return on equity, which is a comparable ratio, totally different than the traditional accounting return on equity. So this is the clean surplus return on equity, which takes out all non-recurring items and future liabilities. So it's very, very important. It's a comparable number. We can compare companies against other companies, where with traditional accounting, you can't do that, folks, really. Yeah, investing is different than accounting, which is different than finance. So let's get into this. Almost twice as much as the average stock in the clean surplus return on equity. Think of it as a bank account. Would you rather put your money in a bank that's paying you 13.5% or a bank that's earning you 23%? Yeah, big difference. Net income is the clean surplus earnings, and we can see that it's far above the average stock out there. Revenue, average stock about 7.1%, Apple 12.3%. Now this is a 5-year average. Let's look at individual years. And here we go. We can see that the clean surplus return on equity is very, very good. We like a threshold of about 20%. Now, the average stock, remember, is 13.5%, somewhere in there. And what is bothering us is 2024. The company did not make as much as it did in 2023, but expected to go up for 2025. Now, this number right in here, this net income, which are the clean surplus earnings, was at about $6.65, expected to be $6.65, but fell down to $6.08, and that's why the drop in the clean surplus ROE. But next year, it is expected to make more than it was just a couple of months ago. A couple of months ago, it was expected to be $7.10 for the year. Now it's up to $7.25. So you can see it's coming back stronger, and that's why the clean surplus ROE is up. Now, one thing to look at over here is that the retention rate, 84.8%, and the 5-year average about the same. That has taken most of the money it makes and puts it back into itself in order to grow. That's very, very important when you're talking about a growth portfolio. You want to see this high. I'd like to see it 100%, but it's a big company. Now, net income growth over 5 years. And coming into, you can see the 5 years, which we went over in the last slide, and we can see that for 2025, it has gone up. The net income growth has gone up to its 5-year average, which is great. Revenue growth, not quite there, but remember, the revenue growth for the average stock is 7.1%. For Apple, it's 9.1%. So it's still a better than average stock, and that's the kind of companies that we look at. Years to pay debt. If it took all the money it's making, how many years would it take to pay off that debt? And Buffett's rule of thumb is 5 years. Our rule of thumb is 3 years or less, and they can pay off their debt in less than a year if it had to. And that means that if interest rates go up, it's not going to bother this company very much at all. And let's go to see the last 12 months. The S&P 500 is this black line down here, and we can see that it's been up over the past 12 months about 22%, with Apple up about 32%. So it's a nice jump above it. But folks, don't forget, this 20% return for the S&P is very, very high, because usually it averages around 10%. So returning 20% over the past year is really very, very good. And so the Apple growing over 30% is absolutely excellent. 5 years, yeah, we can see with the S&P up about 80%. This stock is up about 190%. So you can see that over 5 years, it has been a very, very good return. And we know of a lady who says, I'm only going to invest in Apple, and she has become very, very wealthy over the years with this one stock. So we also talk about diversification. She says, no, I just want Apple. I don't need that diversification. So let's look at the returns over the past 22 years. Now, what's our goal? Our goal is to build our wealth faster and safer with better than average stocks, because 96% of professional money managers that run the publicly traded mutual funds, so we can follow them on a daily basis, 96% of them cannot outperform the S&P 500 over any 10-year rolling period. So we have a 22-year history, little 22 years and 2 months, and our compounded returns are 1,000, let's say it this way, 1,981%. Which is almost 4 times that of the S&P 500, and more than double that of Buffett himself. Now, if we look at the average compounded return per year, you would be looking at 90% per year for our portfolio versus the S&P of 26.6 and Buffett at 39.7. Now, let's look at the simple per year, because those are numbers that we think about each year. S&P is up about 10.4% per year, and that is as of mid-February. So we're looking at 10.4% per year for the S&P 500, slightly below Buffett's 11.9%. Now, Buffett keeps saying he cannot outperform the S&P 500 any longer, and he thinks that he will not be able to outperform the S&P 500 going forward. But he's got a good portfolio, and over the years, because he did so well 20 years ago, 15 years ago, he's up 11.9% a year, which is great, folks. S&P up 10.4. Our portfolio simple, and this is 30 stocks, buy and hold for the whole year. At the end of the year, we rebalance and change any stocks that we need to, which is usually about, out of a 30 stock portfolio, about 5, maybe 6 stocks per year. And we're up 17% per year. So this doesn't include trading or hedging, which we do for some portfolios, or that we suggest for portfolios. And in our newsletter, we tell you when to hedge. So yeah, over 22 years, we're beating everybody that's out there. And remember, we want to build our wealth faster and safer with better than average stocks. That's what Clean Surplus is all about. So folks, we had a good week this past week, and we've been having a good year, been having a good 22 years with a few hiccups in between. But remember, if you want to live on this beach and sail on this sailboat like Jimmy Buffett once did, then you've got to learn how to invest even better than Warren Buffett does now. Okay, folks, you go out, have a great weekend, be with your family, stay safe, take your mind off the market, and we'll be right back here in a couple of days.